Welcome to the fifth lecture of Unit 2 in the Ethan Trades Mentorship. In this lecture, I will go over premium, fair value, and discount within a specific range in price and in the charts. This will help you determine when to buy or sell whatever market you're looking at. You may have heard of the term treat trading as your business before, and if you're new to trading, you probably will hear it in the future. In a nutshell, what this means is to treat trading with a plan and understand that any business comes with ups and downs. One thing that I do want to mention is that because you have chosen to become a trader, it will not be easy at all. The reason I say this is because if you choose literally any other business, you could outsource specific tasks to experts, but in trading, you are the only operator in the business and must master every skill set to be successful. Even if you traded for a firm, you'd have a better time because they have separate departments for analysts, risk managers, and trade executors. In this case, because we don't have that luxury, it means we have to master analysis, risk management, and trade execution all by ourselves. So buckle up for a hell of a ride. As we progress in this mentorship, you will begin to develop your trading plan, which is essentially a business plan in any other industry. In this lecture, I'm first going to introduce you to premium, fair value, and discount prices within a candlestick chart. If we were to treat trading as our business, then we can begin to treat the candlesticks on a chart as our product. By having this understanding, we can apply the same ideology of any business into ours. We want to buy our product at a discount and sell our product at a premium. When applying the concept of premium, fair value, and discount, we refer back to the ranges within market structure. This was taught in the previous lecture. So just like I just explained in the previous slide, this is a visual depiction of what I mean by buying at a discount. When we refer to a range, the upper half of the range is considered premium pricing, the equilibrium or midpoint of the range is considered fair value, and the lower half of the range is considered discount pricing. In this diagram, I've included a bullish range of price. The general idea that I want to get across here is that once price trades back into the range, we generally want to see price trade back into a discount before buying for a continuation higher in the market. And so here you can see this is the range low, this is the range high, this midpoint right here would be that equilibrium or your fair value. And so once you see price start pulling back, you want to see it typically pull back into a discount before you buy and continue higher in the market. Vice versa, this is a bearish example, and this would be the visual depiction of what I meant by selling at a premium. In this diagram, I've included a bearish range of price. Once again, the general idea that I want to get across here is that once price trades back into the range, we generally want to see price trade back into a premium before we sell for a continuation lower in the market. Of course, there are exceptions to this rule, as per any other concept, but as we progress along in this mentorship, I will be providing more ways to determine whether to expect price to trade into premium or not, or if you're in the bullish range, then whether price will trade into a discount or not. There will also be other ways to determine whether price is at a premium or a discount, but for now, just use market structure to determine it, and later on we'll learn some more advanced concepts to gauge whether price is in a premium or a discount. Here is a diagram of how we ideally want to see price action in the markets. On the left, we have a bullish trend, and on the right, we have a bearish trend. Just as you learned in the previous lecture, each leg can be treated as a range. A bullish range being the strong low of the previous range to the extreme high that trades above the previous high and creates a pullback in the market. Vice versa, a bearish range being the strong high of the previous range to the extreme low that trades below the previous low and creates a pullback into the market. So here on the left, the bullish, where we create this initial range, can be our barometer. This pullback trades back into discount. That's where you're looking for your buys into this high right here. And so you would buy from here, probably offload your position up here if you were in a position. So let's say Apple drops down to a discount pricing within this range, and you want to buy your Apple stocks or your Apple shares right here. Once we hit this high, this previous range high, that's where you want to start selling some of your position and prepare for the next pullback. Once again, you're selling, selling, selling. Once we get that pullback back into a discount of the next range, that's where you want to buy again, and then rinse and repeat, right? And so right here, you would want to sell at this high ideally, and selling, selling until you get the next pullback or market structure shift. If you do get a market structure shift, then that would mean you probably got stopped out of your position and you would have taken a small loss, or you would have been stopped out at break even, which means your position, you put your stop loss at break even. So you sold at the same price you bought in, so you don't lose any money. And then of course, the best outcome would be that price hits this high, you offload some position, and then it reverses on you. Vice versa, here is a bearish range. So this initial range here as your barometer for the bearish range, and so you want to wait for price to trade back into a premium. And if you're trading futures, then this is where you're looking for a short. And so from here, you are borrowing assets to sell at a higher price and expecting to buy back at a lower price, right? So it's exact same thing, just opposite direction, where you're trying to sell or short in a premium pricing, and then you would want to start buying back your position once you hit that previous range low. And so you're selling, or sorry, you're buying, buying here. And then once price goes back into a premium, you're selling. And then from here, once we hit that previous range low, once again, you're buying back your position. And so here is a lower time frame in reference to the previous slide. I wanted to show you guys this because once again, I want you guys to keep in mind the fractal nature of price. And because top-down analysis is very important to high probability analysis. Top-down analysis is when we dissect a higher time frame with a lower time frame and look for confluences of the lower time frame to align with the higher time frame. The concept of top-down analysis will be taught later in this mentorship to further reinforce this understanding because it's very important. If you take a closer look, you will see that price on this lower time frame diagram creates ranges of its own. And so by looking at price this way, we can identify when price is at a deeper discount or premium by not only using the higher time frame range, but also using the lower time frame ranges to guide where price is immediately headed towards. So here, for example, you can see this range overall that I've drawn here. And so here you can see that this is going to be your higher time frame range that we just saw in the previous slide. So let's say this is this range right here, this higher time frame range. Dropping down to a lower time frame, price would probably look like this. And so if you look closely here, each of these little trends of their own, these can be used as ranges as well. So now we're pretty much using ranges within ranges. So understanding once this first range gets created, for example, from the higher time frame, then we can see a market structure occur right here at this down move. And so on the lower time frame, we can draw a range looking for sells, right, on the lower time frame into a discount of the higher time frame. Once we're in the higher time frame discount, then we can use the lower time frame ranges once again. Get a market structure shift right here. Let's say we use this range right here, understanding that we're inside of the discount of the higher time frame. We can wait until the lower time frame is also in discount, and that's how you gauge that price is in a deeper discount and get a better entry on the lower time frame rather than just entering on the higher time frame. This is also very important to understand because your lower time frame will confirm your higher time frame analysis 100% of the time. And so vice versa, exactly the same thing. If this range were the higher time frame range, you're just looking at your market structure shifts and your immediate structure on the lower time frame. So let's say you get this market structure shift right here, and this range just got created. So you understand this is a pullback. You're expecting price to trade back into a premium first before heading lower. And so you can buy once price enters a discount on the lower time frame. And then once we're in premium of this higher time frame range, you can gauge for another market structure shift, which occurs over here. And so you can draw your lower time frame range on this leg. And if you did that, then you would see price trades into a premium. Now you understand that price is within the higher time frame premium and the lower time frame premium and starts trading lower. And once again, that would enable you to, one, confirm your higher time frame analysis and narrative, And number two, it would allow you to have a better entry on the lower time frame versus if you were to just execute on the higher time frame. Now moving on to the examples, I've annotated some ranges on different markets to showcase how we typically want to see price move on the lower time frame relative to the higher time frame. So in these examples, the price action you see is the lower time frame, and the ranges you see is the higher time frame range. And so here, just very quick and easy examples. You have this low to this high creating a range. And so look at that, trades back into discount, look for a buy again. From this low to this high creates a new range, waiting for price to trade back into discount. Once again, trades into discount, and you're looking for a buy again. And then you just continue the cycle pretty much here, this low to this high. Once price trades into a discount again, we're looking for a buy and expecting price to trade up here again. Second example here, also another bullish example, right? You have a bullish range here, just our barometer, and then we trade into a discount, looking for a buy here, exiting your position at this high once price gets here, and then you wait for price, right? This low to this extreme high, you're looking for a price to retrace into the discount of this range. Once it does that, you're looking for another buy. You're offloading your position at this high right here. You're going to be buying down here, selling up here, and continue the cycle. So if you trade above that, you're just following price until it drops down into a discount again. So once again, once it drops into a discount, that's where you're looking for your buy, selling at this high, and vice versa. And then right here, you can see that in the next portion of price action, we get a lower price run. And so because we took this range low, you can look at that as a market structure shift. And so what you would be looking for at this point in time is you can draw a new range from the high that's responsible for making the market structure shift. So that would be this high right here. This high is responsible for creating this low that creates this market structure shift. So you can draw this high and just follow price until price trades back into a premium and then look for lower prices. And in this last example, we have a bearish example where we're just taking the ranges once again. We have this bearish range and price trades back into the premium. And that's where you're looking for a sell. You would be taking off your position here. So if you're selling up here, you're going to buy back your position at this low. And then you would just follow price until price trades back into a premium. And at this point, once again, once it's in the premium, you want to take a sell here. And you can take your profits at this low by buying back your position and continue on until you get a market structure shift. And that's when you would shift the sentiment of your ranges as well. That's all for this lecture. I know it was a short one, but this lecture was to introduce you guys to how we view retracements in the market and when we ideally want to buy or sell a market. As always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your charts and try to mark out premium and discount ranges. In the next lecture, I will be covering long-term perspective ranges, and the lecture after that, I will be covering the short-term perspective ranges. See you in the next one, and as always, have a great day.